Three gentlemen are here with me this morning. Good morning to all three of you. You've had a good quarter. Rajesh, I'm going to start with a couple of questions to you first. Your press release said, and you were quoted in that, saying we will continue to maintain our operating margins in our desired band by operating efficiently. I've already asked Chandra whether the utilization efficiencies of about 80 basis points or more that you clocked in the first quarter are continuable or sustainable, and how you see that improving, if at all, in the quarters to come. Can you talk us through what margin levers you have?
So it's a mix of all levers, right? When we speak about our range is about 26 to 28. We are currently at 26.3.
Right.
If you add back the depreciation one-off charge, we'll come in the middle of our range, which is about 27.1. Right. That's the like-to-like number. If you think about what are the kind of levers available, definitely delivery execution capability has been an area of strength for us, and we'll continue to push the boundary on that and really explore what's possible. The other elements is we have continuously invested in various new markets, in new vertical industries. As they scale up, they deliver better margin protection and better margin profiles. We have always called out that European markets, which are strategically very important, typically come at a margin profile in its initial years, which are not. And so as those markets scale up and those engagements get to maturity.
And all of that's going to happen in the next quarter, the quarter to come, the
we're
quarter
talking of on a more of a medium-term kind of a basis. So if you ask us where
3 to 5 quarters.
Yeah, if you ask us where is the confidence coming from, as we scale our new initiatives, they will give us a margin support.
At the end of this quarter, which is underway, will I see another 80 basis point contribution to margin thanks to utilization efficiency?
We'll see a 80 basis point improvement coming off due to the absence of the one-off hits that we had.
No,
so
that's fine. That I could calculate on my own. But about being able to repeat utilization efficiency?
That depends on how the demand environment and the hiring environment turns out. So that's calibrated, which is why we kind of give you the...
But the demand environment you all have already forecasted is going to be good and strong. The hiring environment, Ajoy has laid out numbers last 2 quarters and followed that on track. So all those are predictable. So
everything remains on track, then we will be bang in the middle of our range, which is 27.4.
No, my question is different. Not where you'll be. I know your range by heart now. You can wake me up at 4 a.m. and ask me what TCS's margin range is. I'm saying, will you be able to duplicate this 80 basis point or 90 basis point utilization efficiencies margin boost in this quarter that's underway and the next quarter after that?
So all else remaining the same, we will be at that midpoint of the range.
Okay, let me put this question to you, Ajoy. Can you go beyond 84%, 85%, 86%? I asked Chandra the same question.
Let's just see from a trainee point of view, when we are saying the overall utilization, which is including trainees. Now that the number of trainees that join in Q1 is less as compared to Q2, Q3, Q4. So as more and more trainees come in, so that's the number
that will impact your utilization.
That would definitely. So there is no two ways about it. That is going to have a pressure on that. But as far as utilization excluding trainees is concerned, that is where most of our efficiency is coming from, and that would also be dependent on what is, see, 85% does not mean that, it basically means 15% of non-trainees are not on customer engagements, but they are doing a number of other activities, including R&D, including product development, SG&A management, and there are other activities. So what investments we are doing at this point in time, so it stays on that track. So it's not going to change drastically from a quarter to another quarter point of view. What would change is the kind of hiring that you do in advance, anticipating the work that is going to come in. So those are the factors that would play out, but it's not going to change drastically at this point in time.
Okay, you've also done some fairly strong lateral hiring in the quarter gone by. So can you talk us through what the advantages or the beneficial aspects of that are?
Yeah, see, overall hiring is dependent on the kind of business or the kind of fulfillment that we have to do. Q1 traditionally is the time when you don't have too many trainees coming in, so you plan that in advance. So Q4, the number of trainees that came into TCS, they got trained. It's a 3 months of initial training, and then their deployment is planned during this financial year. So that is the way the whole manpower planning is happening. But Q1 traditionally, if you see, most of the hiring are lateral.
Okay.
Because the number of trainees coming in is less.
So this is in keeping with how things have been for the past 10 years. Nothing out of the ordinary.
No, nothing
out of the ordinary that could boost margins or anything like that in the quarter.
It's more from a demand fulfillment point of view, so that you don't leave money on the table. If there is demand, you are able to capture that demand. And the kind of hiring that would happen is the kind of skills that is forecasted or kind of skills, the demand for which we see in the market. So Q1 traditionally will be more laterals. And as we go forward, more trainees come in as far as India hiring is concerned.
So we're following
the
the same path as we have all these years, and therefore nothing out of the ordinary in terms of expectations. Thank you for talking us down, Ajoy. I really appreciate that. One soft spot has been realizations, down about, I think, 100 basis points, 110 basis points. Talk us through why and what impact that has, or in the coming quarters, how that will play out.
So realization is a factor of the business mix. So typically, I mean, one of the factors, for example, if you look at it this time, you've seen strong growth from US market. The US market has headline realization numbers which will be typically lower than the European market.
Okay.
So, and similarly, when you see growth in your volume accounts with the larger customers, typically the realization number will be lower.
Okay.
So this realization is a, it's a kind of a, because it's an aggregate moving number. So there are two other aspects to it. One is, if you look, it is realization, not pricing. So like-to-like pricing, as we said, is stable. Just that when the mix changes to a lower realization market, you see an impact. Pricing is stable, and we don't see a breakout in either direction, up or down.
So, you have a deal pipeline. You won't share the numbers, but you have visibility of the deal pipeline. So you know whether the business mix in the quarters to come is going to be skewed towards a lower realization region like North America or a higher realization region like Europe. Can you tell us whether realizations will restore themselves, improve, or maybe weaken even further a little bit from here if more of your business is oriented towards North America?
If the demand environment turns out the way we are expecting this year, where we are seeing twin demand coming both from North America and Europe, a more balanced growth coming from North America, realizations are likely to remain stable because one offsets the other. So
stable means you're factoring in this 110 basis point cut through the
this is now the quarter. This is now the number.
So what you've done in the last quarter will be the number to expect in the quarters to come.
That's right. So
that means you're not expecting Europe to outperform, if I may put it that way.
No, we are looking. That's why I said this year we expect balanced growth from both sides.
Okay.
And we've done about 5% at both regions approximately. So, and that's the expectation that that's how the demand is likely to turn out this year.
Okay. I have one more question, Rajesh, before I take it across to both Phiroz and Ajoy. It's a small part of your business, but consulting revenues are down, and I'm just curious to know about, the mix in this case, because consulting is one of your higher value-added, areas, and I'm trying to understand whether some of your higher value-added areas are not doing as well as some of your other lower value-added areas which are doing better.
No, consulting by its very nature is project-oriented. So if you look back a few quarters, consulting has had a very good one, and then it has come off the boil a bit in this quarter. But by its very nature of its project-based one, typically it has that kind of a volatility built into it.
Okay.
It has, rather than from a value-add perspective, it has a higher realization service line. From a value capture perspective, it is not necessarily any different.
So I'm linking this to our realization conversation, right? So if you continue to see, let's say, based on your project flow, consulting to be, slightly less than previous quarters, then that again will impact your realization. So is that the forecast, that you don't expect consulting to restore or do substantially well in the quarters to come? I'm just asking.
No.
That's not
that's not the forecast.
So let's not read too much into the numbers here.
No, I think consulting is not. I mean, there's no secular decline on consulting or anything. It's just a one-off, one quarter.
Okay.
And it had a very good set of 3-4 quarters in the last year.
Of course. I'm just asking what to expect in the quarters to come. So consulting will rebound, and that will help your realizations.
That should help the realization.
I mean, given
it's
the extent of contribution, to your total business. I get that. Yeah, sure. Phiroz?
It's a small number.
Okay. How would you characterize the demand environment, Phiroz? We spoke to Chandra about it. He said things are looking very good. Maybe you'll put some guidance to it?
Guidance? As a company,
I've got to try my luck, right?
I don't know what word Chandra used, but I'll just call it robust.
Okay. Oh, it's close. All the same similar sounding adjectives. Things are looking good in your part of the world, Europe, UK, strong growth?
We have seen strong growth. The pipeline is strong. It's been a traditionally growing market for us. Unless there's some major macroeconomic environment that causes a problem, we don't see that coming off the boil, so we expect that growth to continue.
Okay. What would you list as your top challenges for that market? Because Europe has been volatile. In terms of macro growth expectations over the last few quarters, that has also been the case with the US. It's the question I put to Chandra, I'll put to you again. many people are expecting the second half could be weaker than anticipated. From a macro GDP growth point of view, I'm saying.
True, that has a bearing on our business, but at the same time, the nature of our business is such that the deal pipeline gets determined fairly substantially in advance. So unless there is a major macroeconomic change, there's no reason to believe that that pipeline will sort of fall off in any way going forward.
Okay.
So if you look at our pipeline, everything that's gone in, deals that are being negotiated, deals that we are bidding on, there is no reason to indicate that there will be a major shift.
Okay.
The robust demand and growth.
I'll tell you why I was asking, because you all have maintained that the second half will not be as good as the first half, or let me rephrase that. The first half will be better than the second half. And I was wondering, is that simply because those are traditionally slower quarters for you? Or is it because you also anticipate that some of this glumness on the macro view has started impacting order flow and that will show up in the second half?
We are not seeing that in our business.
Not at all, okay.
So it's just historically that is the way it has been because of the holidays, the furloughs. By the time you come to the end of the year, you're working on budgets for the next, and the first quarter, always budgets haven't fully kicked in. So there are these traditional cycles.